So, Twitter user Zamanskin Stati recently posted something that, well, caused a massive debate in the Pi community. He said, and I'm paraphrasing here, don't rush into Pi right now, wait for healthy corrections before you invest. Now, predictably, the comments just exploded. Half the community accused him of spreading fear, while the other half actually thanked him for the reality check. But here's what nobody's really discussing. Why would someone with skin in the game tell people not to buy? Let me explain what's actually happening here. When experienced traders tell you to wait, they're not bearish on the project, they're actually protecting you from the most common wealth-destroying behavior in crypto buying during emotional peaks. Think about how markets actually work. Prices don't move in straight lines. Every rally, whether it's Bitcoin, Ethereum, or Pi, is followed by consolidation. That consolidation is what traders call a correction. It's not a crash. It's not failure. It's just the market taking a breath before the next leg up. Here's the part that hurts. If you buy at the peak of excitement, you're essentially buying from smart money that accumulated weeks earlier. They're taking profit while you're taking risk. That's not investing. That's gambling with a disadvantage. Pi Network has unique dynamics that make timing even more critical. Unlike established coins with years of price history, Pi is still in its price discovery phase. Volatility isn't a bug, it's a feature of early-stage assets, and volatility creates both opportunity and danger depending on when you enter. Understanding what corrections actually mean. Let's talk about corrections without the technical jargon. Imagine you're watching a balloon being filled with air. It expands, expands, expands. Then someone releases a little air. That release prevents the balloon from popping. Market corrections work the same way. After Pi experiences price increases, some investors take profits. Others who bought in panic realize they overpaid and sell. This creates temporary downward pressure. The asset reprices to a level that reflects actual demand rather than pure speculation. Why does this matter for you? Because buying during the release phase means you're getting Pi at a discount compared to the people who bought at the top. You're entering when fear replaces greed. That's when smart money accumulates. The smart play isn't avoiding Pi. It's timing your entry during stabilization rather than excitement. Let me give you a concrete example from Bitcoin's history. In 2017, Bitcoin hit nearly $20,000. Everyone said buy now or regret forever. People who bought at 19,000 watched their investment drop 80% over the next year. Meanwhile, investors who waited for the correction accumulated Bitcoin between $3,000 and $6,000. They made life-changing returns. Pi won't follow Bitcoin's exact pattern, but the principle remains. Corrections reward patience. Now here's what makes Pi different from most crypto projects. Pi Network built its foundation on mobile mining and community participation. Tens of millions of users already hold Pi. But holding and trading are different activities. As more holders migrate to exchanges and begin trading, price discovery accelerates. This creates volatility, both up and down. If this perspective is shifting how you think about timing your crypto investments, hit that like button right now. It helps YouTube show this video to more people who need to hear this message. And if you're not subscribed to TJ Crypto World yet, fix that immediately. I'm consistently bringing you the strategy that protects your capital while maximizing returns. Hit subscribe and turn on notifications. Now let's continue. Crypto markets run on emotion more than fundamentals, especially in the early stages. Fear of missing out is the most expensive emotion you'll ever experience as an investor. Let me paint you a picture of what FOMO looks like. You see Pi's price climbing. Your Twitter feed fills with moon emojis and rocket ships. Someone posts a screenshot of their 300% gain. Your stomach tightens. Your brain starts calculating what you could have made if you'd bought earlier. That anxiety pushes you toward the buy button. Here's what you don't see. That person who posted their 300% gain probably accumulated Pi months ago when nobody cared. They're not buying more, they're celebrating. You're entering after the move already happened. Contrast that with strategic investing. Strategic investors watch price movement, but they make decisions based on value, not emotion. They ask, is the current price reasonable given the project's development stage? Has volatility created an opportunity? What's the risk-reward ratio right now? So, this mindset actually protects you from two devastating behaviors, panic buying at peaks and panic selling at bottoms. Both of these, honestly, pretty much guarantee losses. Pi Network's community is, well, super passionate, and that's fantastic for long-term adoption, but it can be dangerous for short-term trading. Passionate communities tend to amplify both euphoria and fear. When prices rise, optimism spreads like wildfire. But when prices dip, anxiety just floods the forums. Neither emotion, honestly, helps you make profitable decisions. The real antidote here is process. Decide your entry criteria before emotion takes over. For example, you might say, I'll buy Pi when it stabilizes for 7 days after a 20% correction from recent highs. Now, you're following a strategy, not just your feelings. Web3 utility changes everything. So, let's talk about something that actually matters for Pi's long-term value utility. Web3 isn't just a buzzword, it's the framework that determines whether crypto projects survive, or, well, just disappear. Pi Network is actively building decentralized infrastructure. They're developing smart contracts, enabling developers to create applications, and establishing the foundation for real economic activity. This isn't speculation, it's construction. Here's why this matters for your investment timing. In the early stages of any crypto project, price is driven by speculation and hype. As utility develops, price begins reflecting actual usage and adoption. The transition from speculation to utility creates volatility because the market struggles to price future value. Smart investors recognize that Pi's current price movements reflect speculation more than utility. That's not a criticism, it's just the reality of early-stage assets. But as the ecosystem matures, fundamental value becomes more predictable. This creates an interesting dynamic. Buying during the speculation phase is high risk, high reward. Buying after utility proves itself is lower risk, moderate reward. Neither approach is wrong, they're just different strategies with different risk profiles. If you're a risk-tolerant investor comfortable with volatility, buying during corrections in the speculation phase could generate outsized returns. If you prefer stability, waiting until Pi demonstrates consistent utility and adoption reduces uncertainty. Know yourself. Choose accordingly. What to watch before you buy. Let me give you the practical checklist I use when evaluating entry points for early-stage crypto assets like Pi. These aren't guarantees, but they're signals that improve your odds. First, watch for price stabilization. If Pi's price bounces around wildly today but flattens into a range over the next week, that suggests the market found a temporary equilibrium. Equilibrium is your friend. Second, monitor mainnet progress. Pi Network's migration to open mainnet is critical infrastructure. The smoother this transition, the more confidence investors gain. Track official announcements and community feedback on mainnet performance. Third, evaluate ecosystem growth. Are developers building applications? Are businesses integrating Pi for payments? Is the community actively using Pi beyond just holding it? Usage indicates real demand, which supports price. Fourth, pay attention to community sentiment without being controlled by it. Healthy communities debate, question, and analyze. Cult-like communities only celebrate. You want rational optimism, not blind faith. Fifth, stay informed about regulatory developments. Pi Network operates globally, which means navigating different legal frameworks. Regulatory clarity reduces risk. Regulatory uncertainty increases it. Use these 5 factors as your compass. They won't predict exact price movements, but they'll help you identify favorable conditions versus risky environments. If this breakdown gave you a clearer framework for thinking about your Pi investment, show it some love with a like. Share this video with someone in the Pi community who's wrestling with the same question. Subscribe to TJ Crypto World if you haven't already. I'm bringing you strategy-focused content that helps you make smarter decisions in crypto. Drop a comment telling me your entry strategy for Pi. Are you buying now, waiting for corrections, or staying on the sidelines? Appreciate you spending this time with me, crypto strategists. This channel exists to help you navigate crypto with intelligence, not emotion. Check out my other videos breaking down Pi Network's ecosystem development and broader Web3 trends. Stay strategic, stay patient, and I'll catch you in the next one.